Hello everyone and welcome to another video. This one is going to be on telling you guys about 5 market-beating ETFs that are among my personal favorites. So what do I mean by market beating? For an ETF to make this list, it should have an annualized rate of return similar to or more than the S&P 500 index and must have a lower downside risk than the overall market based on the ETF's historic performance. These aren't going to be some obscure ETFs, but ones that are well established, and 4 of these 5 are Vanguard funds. The premise behind picking these ETFs are as follows. ETFs offer instant diversification for very low fees or expense ratios. Next, while if you buy the S&P 500 index, such as VOO from Vanguard, then you will just receive whatever the market is returning. However, the key insight I used to build this list is that there are certain sectors within the broader economy that tend to be less risky or provide a higher rate of return relative to the average. If you combine that insight with a fund's historic performance, you can quickly narrow down the number of ETF options. Now, this video is a follow-up to my earlier video in which I compared the performance of 25 of the most popular ETFs out there, so I highly suggest you go and check that video out, as the conclusions may surprise you. So without any more delay, let's get started. Coming in at number 5 is VUG, or Vanguard's Growth ETF. This fund has returned an annualized rate of return of over 16% in the last 10 years. For reference, the historic average of the entire stock market is about 8% return. If you invested $10,000 in this fund 10 years ago, you would have over $45,000 today. The fund also has a lower correlation to the broader market on days that the stock market does poorly, which is captured by this 0.95 number. I did an entire video explaining what asset correlations are, which is linked in the descriptions below, and I suggest you go check that video out as well, as asset correlations are an important way to build intuition behind the behavior of different types of investments. However, for the purposes of this video, you can think of the correlation number as follows. If the stock market falls by 10% tomorrow, then this fund would fall by about 9.5% based on the historical average behavior. A correlation of 1.00 would mean that the stock would fall by 10% if the market falls by 10% tomorrow. This is great because you can have some certainty that this fund, based on historical average performance, is slightly less riskier than the overall market. The fund also has a very low expense ratio of 0.04% and a dividend yield of 0.67%. The largest holdings include high growth names such as Amazon, Tesla, and Nvidia. Next at number 4 is VIG, or Vanguard's Dividend Appreciation ETF. This fund consists of very stable large cap blue chip companies that have consistently raised their dividend. This fund has returned an annualized rate of return of about 12% over the last 10 years. If you invested $10,000 in this fund 10 years ago, you would have over $31,000 today. These companies are viewed as very safe and contain some very familiar household names such as Walmart, Procter & Gamble, and Microsoft. These companies are in no threat of going out of business, and you can be assured that they are likely to survive any downturn in the economy. These companies have strong balance sheets, which makes this fund full of high-quality stocks. Now, the return here is not as stellar as VUG, but the safety and confidence you can have in investing in this ETF is unparalleled. This ETF has a downside market correlation of 0.96 and has a very low expense ratio and a dividend yield of 1.65%. Coming in at number 3 is Charles Schwab's US Dividend Equity Fund. This ETF has had an exceptional performance, beating the market in both the 2008 financial crisis and the 2020 market crash. The ETF returns an excellent 3% dividend and has a low 0.06% expense ratio. The 10-year ROI is over 14%, and if you invested $10,000 10 years ago, you would have over $35,000 today. The ETF has an even lower correlation to the market downturns compared to the previous 2 ETFs at 0.93. The top holdings have great names such as 3M, BlackRock, and Qualcomm. At number 2 is Vanguard's Healthcare ETF, VHT. This fund has returned an annualized rate of return of over 16% in the last 10 years. If you invested $10,000 in this fund 10 years ago, you would have over $46,000 today. What I absolutely love about this fund is its stability. The healthcare industry is not very cyclical, and this fund has a downside market correlation of the lowest value in this entire group. This means it is the safest ETF to own if you are concerned about losing money in a market crash. The expense ratio is a low 0.1% and the dividend yield is a healthy 1.2%. The fund has some excellent companies in it such as Medtronic, Pfizer, and Eli Lilly. Number 1 is Vanguard's Information Technology ETF, VGT. This fund has returned an eye-watering 20% annualized return over the past 10 years. And if you invested $10,000 10 years ago, you would have over $60,000 today. That is a phenomenal return on your investment. The fund has a very respectable downside market correlation of 0.90 and has an expense ratio of 0.1%. It yields a 0.67% dividend yield from high-tech companies such as Apple and Microsoft. If you believe that technology companies will continue to be innovative and a large driver for economic growth in the coming years, then there are not many options that are better than VGT. There you go. Consistently investing in these 5 ETFs will surely make you rich in a safe manner. I hope you enjoyed this video, and if you found the content to be informative, then please consider liking the video and subscribing to the channel. I'll see you guys in the next video.